All right. So we're going to be diving into, again, S corps, going into the secret, really the truth about S corps. A lot of this stuff is new for some people, things that they've probably never heard about when it comes to S corps. But a lot of the stuff is maybe you heard about it before. We're just going to take a little bit deeper dive. So these are things that we're going to be talking about specifically. These next few sessions is going to be related to S corps. As always, none of this information should be relied on as tax, financial, accounting, or legal advice. Consult with a tax attorney or a tax professional when it comes to legal issues, tax issues, things like that. Obviously, if you work with our team, you work with us moving forward to implement a strategy, we will be providing you with actual tax or legal advice. Um, Again, who we are, Prudent Wealth Strategies, myself, Stefan, my wife, Michelle here. We are tax strategists, trust and estate specialists, and we work with business owners, investors all over the country. We also work with a lot of tax firms. I had two CPA firms in North Carolina just reached out to me last week to do some continuing education for them and some consulting. So we do a lot of that, as well as we work with a lot of high net worth families. And our goal is really just to educate, make people aware about a lot of these concepts that most advisors, most CPAs, even attorneys just don't inform their clients about, and help them to put a good, efficient pathway forward. So that's essentially who we are. We have a whole team of fiduciaries, forensic CPAs, tax attorneys, estate planning attorneys, enrolled agents, specialists, you name it, that help our clients implement and understand these things. And I really want to stress our team because without our team, really, we would be very, very beneficial because that's a lot of the information, things that I've learned is from these specialist people. I've been doing this stuff for years and years and years. And I love learning, and it's a lifetime process to learn and get familiarized with some of these things. Um, our process is education, evaluation, execution. We really start with the education, helping people get informed, become aware, and kind of understand these concepts versus just going into, hey, this is kind of how it works, and let's implement the strategy. A lot of people, they want the quick fix, they want the wham bam, thank you ma'am solution. We live in a very microwave generation, and they want to focus on the execution, on the doing. And that's fine. Eventually, you're going to have to execute something. But it's so important to kind of understand how things work, evaluate it, understand how it's going to work in your particular situation and your circumstances, because everyone's situation is different, and then execute. So that is our process. So we want to move from the execution first and foremost and start with the education. All right, so just a recap from last week's session. What S Corps were about. Again, if you did not attend that session, go watch it on our YouTube channel, the Tax of the State Academy. But what are S Corps again? Again, it is a tax election. It is not an entity. S Corps are not entities. A lot of people like to think they are. There's some separate entities. No, you set up an LLC or an Inc., and then you choose to become, you make the election become S Corps. And when you do that, obviously, what we're going to be talking about today is some of those decisions can be devastating for yourself and for your family. So we want to kind of avoid that. Obviously, the benefit is when you set up an S corp, there is no corporate tax. All the income just passes through to you. So there's no double taxation. You're not getting taxed on the corporate level and then the individual level. Everything just passes through to you. Pay yourself a reasonable salary and take a dividend or income distribution from the corporation. But the thing to kind of understand, and this is kind of the our end point of last week's session, is that owners have full liability. So if you're an owner of an S corporation or a member of an LLC that elected to become an S corp, you still have full liability. So the asset protection that people think they have, it's not as asset protection friendly as people like to think. And again, watch last week's session; it'll make more sense to you. So the first thing is let's talk about death tax, the death tax. A lot of times when people think about death and taxes, they think about estate taxes. And yes, there's been a lot of changes with the estate tax and a lot of things when it comes to estate planning with the new tax legislation, the one big beautiful bill legislation. But it's not just about estate taxes. A lot of times when we talk about trust and estate planning, different things, people have this conception, oh, I'm not I'm not at that high net worth. I'm not at a 15 million, $30 million net worth. I don't have to worry about estate taxes. Yeah, you do. You do have to worry about taxes when you die, especially if you have properties in S corporations. Now, the way that it works is when you die, your heirs, your kids get what's called a stepped up basis. Most of you guys that are in real estate are probably familiar with this, but for those of you that are not, all that means is that when you buy a property, whatever the fair market value that you buy it at, when you die, your heirs get the new fair market value or stepped up basis. So let's say you bought a property, it was worth, $500,000. By the time you die, you've had it, 30 years, it's worth, $3 million. Your heirs, when they sell that property, they don't have to pay a capital gain because now the property in the eyes of the government is worth 3.5 million or whatever the new fair market value is at the time of your death. So that helps your heirs, avoid any type of capital gains taxes on the federal level and the state level when they sell your property. So a lot of assets, including real estate, get that stepped up in basis. But here's the thing, when you have property that is owned by an S corp, the S corp, again, what people have to understand is S corps are business entities essentially, but they're elections, right? So the property itself does not get a step up in basis because the S corp really doesn't have its own step up in basis. So when your heirs sell that property that's held inside the S corp, they get hit with huge capital gains tax bills. And there's nothing they can do about that because you passed away, right? You can't make any changes to that. So it's just super important to kind of understand that, hey, it's not just about estate taxes. It's about, hey, when you pass away, whenever that's going to be, we know it's going to happen. We don't know when, we don't know how, but we know it's going to happen. If you choose to leave your properties in an S corporation, and your heirs inherit that, they're going to sell it through the S corp and pay a whole bunch of taxes. And this is an example that we had dealt with last year. Unfortunately, there wasn't a whole lot. We could do some damage control. We helped them out some, but we couldn't do much because our hands were tied because everything was held in an S corp. But basically, it was a rental property bought for about $300,000 by dad, and he bought it in a solo S corp. So he's a sole S corp owner. And when we talk about S corps, obviously everyone's situation is different, but for the most part, we're referring to solo S corp. So we're talking about someone, hey, you start a business, you're the sole owner of that business, and you operate as an S corp. Obviously, there are situations where you have three, four, five, six different owners, but either way, the way it shakes out is still going to be the same. So bought a property, $300,000. Now the property is worth 1.8 million. They thought, and everything was set up right with from an estate planning standpoint. They inherited the S corps shares and all that stuff. When dad dies, kids wanted to sell. Again, the sale has to happen within the S corp because the S corp owns the property. So they sold that property for 1.8 million, but now they have to deal with that 1.5 capital gain. So that difference, they don't get that stepped up in basis, which was a huge gut punch to them. So this is a big thing that people just don't understand when it comes to inheriting property that's held in an S corp. Any questions about this? You can unmute yourself if you want to, or type it in the chat. If not, we'll move on. All right. So rental properties. This is another thing. A lot of people have rental properties, and they'll put rental properties. They'll say, "Hey, let's do an S corp because S corp's going to save us money in taxes, and we get that asset protection again, which we understand now. Again, if you go back, watch part one, it'll make more sense. But S corps simply just do not give you as much asset protection as a lot of people like to think." The issue with putting rentals, and when I'm talking about rentals here, I'm really talking about it from a long-term rental standpoint, not short-term, not Airbnbs, things of that nature. But even with short-term, there's still reasons to not have it in an S corp. But the rental income inherently, from a tax standpoint, is passive. It's all passive income, which means there's no self-employment tax. That's the main reason why you would set up an S corp, right? You would change your tax designation to an S corp is to avoid that 15.3% self-employment tax. But that rental income already avoids self-employment tax. So again, operating your business through an S corp and having those properties in the S corp and taking all of that rental income, it's really gonna doesn't make any sense. You get all the downsides like the stepped up basis trap that we talked about, and none of the upsides, none of the rental passive income, things like that. So it really doesn't help you out. The recommendation would be to just set up a straight LLC or utilize a dynasty trust. We're going to be going over more of that in detail towards the end. So long-term rentals, definitely don't want to have those in S corp. Makes no sense. Fix and flips. This is really the only, I guess, exception to the rule, is that if you are operating a business where you're buying and selling property within a year, that's an active business. So you're obviously going to be subject to that 15.3% self-employment tax. So, setting up an S corp would probably help you out because it's going to, save you, money on that self-employment tax. Those distributions, again, that dividend, the money that you're taking from the S corp, that's not part of your salary, avoids that 15.3% self-employment tax. So operating your business through the S corp might make sense, but only for business operations, not for holding the properties in the S corps themselves. And we guide people, as part of our process, and how to do that and how to separate, their business activities and what they're doing, even if they're buying and selling properties, versus, hey, this is how we take income distributions from it. So again, same recommendation: set up an LLC or utilize a dynasty trust. Again, in everything will coexist in what you're doing. So you don't want to burn everything down. We just want to kind of complement what you're doing and redirect income efficiently so you're not getting killed with taxes every single year. Locked in properties. This is a big, big thing. This is probably the biggest thing when it comes to owning properties inside of S corporations, is once the property is in the S corp, you set up an LLC or an Inc., you make the election to become an S corp, then you go buy property in the name of the S corp. Again, because people want that supposed asset protection, right? Nothing wrong with that. We all want asset protection. But once you do that, then it's hard to get that property out, because essentially what you have to do is you have to distribute the property to the shareholders, and that is what the IRS considers a taxable event. It's income. It may not seem like it's income. It may seem like you're just taking an asset from one pocket and putting it into the other, but from the eyes of the IRS, it's not. And so essentially what happens is that S corp has to sell the property to you, the shareholder, at fair market value. And so it makes it very difficult to, move the property to a different entity without having a huge tax bill. So if you have not put a property in an S corp yet, if you're thinking about it and you haven't yet, good. You will avoid all of these different things that you're seeing here. But if you already have your property in the S corp, and you're looking to sell it or whatnot, there's not a whole lot we can do. It's pretty much damage control at this point. Okay, so owning real estate inside S corps while you're alive, not just while you're dead, but while you're alive, can be very problematic from a tax standpoint. 1031 exchanges, which at the end of the day, and this is why I had this illustration, all a 1031 exchange is you're kicking the can down the road. You're not really avoiding the tax, you're deferring the tax to a certain point in time, which is when you decide to eventually get rid of all the real estate that you've exchanged. Now, for those of you guys that are not familiar with 1031 exchanges, and there's a whole other training that we have on capital gains, 1031 exchanges, alternatives, all that stuff. is a 1031 exchange is basically you taking the gains of a property, of an investment property that you have, and instead of you selling it and to a new buyer, you take the money and you put it into another property of equal or greater value. There's lots of nuances, what type of property you can invest in. You have to identify properties within a certain time frame, close within a certain time frame. There's a whole bunch of different things with 1031 exchanges, but this is a tool that a lot of real estate investors use to essentially avoid capital gains taxes. And what you're doing is you're basically just kicking the can down the road. And a lot of people like doing this because, if you got a property that's appreciated a lot, or if you've taken a lot of depreciation, which a lot of people in real estate, they love depreciation, they love their cost segregation, bonus appreciation, different things like that. It kills you on the back end when you essentially, sell that property because all of those depreciation deductions have to get recaptured. So a lot of people like 1031 exchanges for that reason. And as um, an S corp can do a 1031 exchange. But the problem really doesn't change. The property is still trapped inside that S corp with the low basis. Again, no step up in basis. And so when you eventually sell the property or when you die, there's a huge tax bill. So a 1031 exchange, it is an option to defer taxes. But if you're looking to do the whole swap till you drop, which is basically, you keep exchanging and then when you die, your kids get a step up in basis. Can't do that with S corps. Property is held in S corps. A lot of people don't realize that, even CPAs. And we teach a lot of this stuff to them. So you just have to be a lot more efficient when it comes to different things with real estate. So with that, and I'm going to bring up my iPad. We'll get into some illustrations. I want to get into Q&A. But we're going to talk about improving your S corp position, which is basically just understanding how the tax code works, and how to efficiently redirect income in a way where you're not getting killed with taxes. So we're going to talk about spousal partnerships, LLC partnerships, and dynasty trusts. So I'm going to get into that. But before I do, are there any questions about anything that I went over so far? I'm going to take a little break and get something to drink. Any questions? Anything that anybody
I,
wants to
I just
say?
wanted to mention, I just wanted to ask this question. Has anyone here ever done a 1031 exchange? And please unmute so we can hear you.
Yeah.
Sandeep, have you ever done a 1031 exchange? I see you unmuted.
Oh, I'm sorry, not unmuted, but I didn't.
Okay. Um, okay, so I just wanted to add, Stefan, that a lot of we hear a lot of clients that, end up that we work with, and they've had such a headache with the 1031. They get so upset that they're really restricted. There's so many restrictions with the 1031 that, you have to see what's, in the market at that time. You have to, meet those requirements, the finder's requirement and the closing and all of that. So it can be a real headache. You hear a lot of people in real estate, oh yeah, we can do a 1031. And like Stefan said, you're just kicking the can down the road. There's a lot of restrictions. It can be very frustrating, and there are other alternatives.
Yeah. And we're going to get really into that when we start talking about the dynasty. Again, this is all about being, more efficient, as efficient as we can possibly be with the resources that we have. So I'm going to throw up can you hear me, Shelley?
I can hear you. Your
Okay.
view changed.
Yeah, I know, because I'm on my iPad now. So,
Okay.
so I'm gonna throw up my whiteboard here and kind of walk us through the first strategy, a simple strategy on S corp income and kind of how that works, which is the spousal partnership. So, give me 1 second here. All right, here we go. All right. All right. Can you see this?
Yes.
Okay. So let's kind of walk through real quick what a partnership is, because a lot of people make this super complex. A partnership literally is just more than one person in a business together. That's it. It's not hard. It's not complex. More than one person in a business. This could be 2 people, 3 people, 4 people. There's different restrictions, different nuances when it comes to partnerships on the state level, different ways to set up partnerships, general partnerships, limited partnerships, family limited partnerships. We could go on and have an entire master class on partnerships. But the reason why I want to explain it from a simple standpoint is that when we're using the spousal partnership as an alternative to an S corp, we're accomplishing this essentially the same thing, but through a different way. So again, going back to our initial thing with S corps, is the main thing is that self-employment tax, right, of 15.3%, right? We got to deal with that on any sole proprietor income, any income that's coming directly to us. So by doing an S corp, when we do the S corp, how does that 15.3% actually get reduced? Well, it gets reduced because we're going to pay ourselves a reasonable compensation, and we're going to pay ourselves a dividend. Okay, dividend distribution, it's all the same thing. This dividend is pass through income. Okay, so again, all of this passes through from the S corp to the individual. Okay, so now this person has that money, and then that reasonable compensation, that's a W-2 salary that you pay yourself. And again, there's lots of nuances and what you have to pay yourself and how much you have to pay yourself and all that stuff. But this is the only part that would have that payroll tax. Okay, so you're not paying that self-employment tax on 100% of your income. You're only paying it on a portion of the income, which is the payroll, okay, which is basically earned income. So that's essentially what we're doing, is we're trying to create as much pass-through income so that we're not paying 15.3% tax on it. Well, the spousal partnership does the same exact thing. And the way it does it is through this, is we set up a partnership. Now, obviously, this is not going to be applicable to everybody because not everybody has a spouse. Maybe you're single, maybe you're a widow, right? So this isn't an option for everybody. And I'm not telling you, this is not marriage advice. I'm not telling you to go find a spouse so you can implement this strategy. Again, we don't give tax advice or marriage advice. But all we're doing with the spousal partnership is we're having a general partner or managing partner here. And then you're going to have your spouse, and they don't have to be in the business. Okay. If you're a doctor, we do this a lot with people in the medical profession. Whether you're a doctor, you're an engineer, whatever, if there's a specific license that you need to have in your business, guess what? Your spouse does not have to have those same credentials when we're implementing this strategy. Because when we do this, you are the general partner, and then your spouse is a limited partner. Okay. What's a limited partner? It's just an investor. Okay. They don't have to have any credentials. They don't have to have any type of certificates or anything like that. They're just investing money. So when you set up a spousal partnership, it's no different than any other entity. You got to set up the entity, set up a separate bank account. You'll, capitalize, invest something in there. Your spouse would invest in there. But the income, essentially, depending on how you structure that limited partnership income is pass through. It's passive. Okay. Pass through, depending on how it's structured. A lot of people get these things conflated. But this would pass through, doesn't pay any corporate taxes, and it goes through to your spouse, which if you're married, filing jointly, that would go through your joint income tax return. But this does not, there's no 15.3% self-employment tax. So this is out of the way with that LP investor income. So depending on how you structure that LP agreement, hey, they're going to have a 20% stake or 40% stake. I mean, you can make this, you can structure this. Obviously, you have to look at your operating agreement and how we're investing, how your spouse or you guys together are investing into the partnership. But we can basically suck a lot of income through this partnership so that there's as little of that 15.3% tax as possible. So now you're only paying that 15.3% on this income right here. So we can essentially accomplish the same exact thing as an S corp, but the difference is we don't have to worry about reasonable compensation. We don't have to worry about compliance. It's actually a lot less, compliance-wise to do this versus doing an S corp. An S corp, you got to file a separate tax return. You got to do books. You have to make sure everything's done the right way in order for your S corp to actually be valid and work. But also from a legal standpoint. So this is actually a lot more efficient to do things this way, and you can save a lot more self-employment taxes by doing this because you have control over how we structure the LP versus S corp. There's a required salary, reasonable compensation you have to pay yourself, and again, there's lots of different things on what goes into that amount. So this actually gives you a lot more control. But this is a way to, do whatever type of income that you're doing, but have it as an alternative as an S corp, and you're essentially accomplishing the same thing, but a lot less, much easier and a lot less complex.
Stefan, I know we're looking at your shared screen here on your iPad, but your thumb is like over your camera, like for
Oh,
your
sorry.
just so you
I
know.
apologize. Any questions about this? Does anyone want to unmute?
Does anybody have a spousal partnership right now?
Got someone on live stream saying, yes, how does this work in Tennessee? It doesn't matter what state you're in. Different laws, I should say different states do have different laws over partnerships because they're statutory entities. So again, your operating agreement, all that stuff has to comply with whatever you're putting together. But there's no reason that you can't do this in Tennessee. It really doesn't matter what state. You just have to set it up. So, but a good question, because we do get that a lot of as far as partnerships. Partnerships actually are a lot more efficient on a state level than S corps do, because depending on your state, like New York or California, there's a lot of nuances with S corporations. It's in a lot of cases, it's not even beneficial to have an S corp. You're not going to save any taxes. So in those states, especially, it makes a lot of sense. A good question. All right. So no questions on that. That seems pretty simple and easy for you guys to digest. We'll go into LLC partnerships and dynasty trusts and really dive into kind of how this works from that standpoint. So let me change my back to my whiteboard. Okay. So when we're talking about the dynasty trust, again, the main thing, and I would go back to our YouTube channel if you haven't. If you're part of the T program, we have all the tools and resources in the Tax and Estate Academy. You can just go in there and watch that, or better yet, schedule one-on-one with me, which all you guys that are in the program have access to do that. So But essentially, the main thing we want to understand is that all we're doing when we set up the dynasty trust, again, it's a separate entity, right? It's got a separate tax return. It's got the 1041 tax return. It's got a bank account. It's got an EIN. It files its own books, does its own profit and loss statement. So it is a separate entity from you for tax purposes. So when we talk about the S Corp, again, everything flows through with the S Corp. With the Dynasty Trust, there is no flow through. Okay, it is an irrevocable trust. It is a non-grantor trust, which is super important, and we go over that in our training. Again, watch the Dynasty Trust Masterclass training to understand all these things more. But it's separate from you from an estate planning standpoint. So it has nothing to do with you. You're just the trustee of that trust, and we're allowing income to be redirected into the trust through passive sources. So when we're using the dynasty trust, essentially, it is really no different than the spousal partnership. The only difference is we're making the dynasty trust your partner, your limited partner. So we will set up an LLC, elect it to be taxed as a partnership. So we have the partnership here. And then same thing, we'll have you as the general partner or managing partner of that LLC. And then we'll basically establish a limited partnership relationship with the Dynasty Trust. Okay. And what this does, it allows us to redirect income through this LLC that you're getting taxed on, right? Because this is where all the income is coming from. Without this, we're dealing with taxes that go to you, right? Everything goes to you at the end of the day when we're doing things like 99% of the people out there, right? You have to take a distribution, you take a W-2 salary if it's an S Corp, right? And you take a dividend and it all goes to you and then you get taxed. So all we're doing is we're saying we're going to take this limited partnership, we're going to structure our operating agreement to reflect a limited partnership arrangement where that dynasty trust can take, let's call it 70% or 80% of the net income from that limited partnership agreement. Okay, so we're redirecting that income into the dynasty trust from your LLC. Again, separate entity, files its own tax returns, bank accounts, all that stuff. And as long as that money stays inside the corpus of this dynasty trust, there are no distributions, there's no tax. So think about, again, if we think about the 1031 exchange where we're just kicking the can down the road, right? We're kicking the can down the road here as well, but we're kicking the can down the road for decades, for generations. And this is what allows business owners and investors to grow their wealth exponentially because they're not getting killed with taxes every single year. And then they can use the money inside the Dynasty Trust to pay for education, pay for, assets, vehicles, real estate, all these different things.
Healthcare
All the things that you did on an individual basis, but you're doing it on a trust owned basis now. So you're only paying taxes on whatever income portion that you're taking from that general partnership. So this is where you would pay the tax. Okay. But again, it's all about figuring out, hey, how much do I need to live on? What are my expenses? What are things that are, can't be paid for by the trust? So it's a much deeper conversation when you're, involving this strategy, but it accomplishes the same thing, if not more efficient than doing things in an S Corp. And you have a lot less restrictions. You don't have the tax hits. You don't have the death tax traps. And it's just a much more efficient way to do things. But we're just using the tax code in a way that's more beneficial to you and your family.
And when you pass there, you don't have any of that tax for your heirs.
Yeah. You don't have to worry about step up in basis. And a lot of people say, oh, well, it's an irrevocable trust. My kids don't get a step up in basis. Well, they don't need step up in basis if they're not paying taxes, if they're not taking a distribution. They can just keep everything inside the corpus of the trust and just keep it growing. Okay. So lots of different things to consider here, but this is just another, smart, efficient way to use a tax code um, to your benefit just by making a few different small moves here and there. Any questions on this? You can unmute yourselves. Anybody? All right, I got David from, let me just open this. I'm gonna open this on my computer because I can't see it on my iPad. David is asking, what happens to the money in the trust when I die? So yeah, so good question. So the money in the trust is going to, anything in the trust, whether it's money, real estate, all that stuff, it stays in the trust. Your beneficiaries, your heirs, when you pass away, would essentially become the new trustees, and they can basically keep the trust going. So if they say, hey, we want to sell this property, they can sell the property within the trust. All the money, again, goes back inside the trust. It doesn't go to them. So there's no taxable event. It just stays within the corpus of the trust. We designated the income to stay in the corpus of the trust. So that's what's happening when when your heirs are inheriting properties. They're not essentially inheriting property themselves. The trust is inheriting it. If you're using a living trust, then yeah, they would, distribute everything from the trust. If there's a taxable event, they would pay tax. But now all the property's in their personal name, and they have, liabilities, lawsuits, everything's attached to them. So by keeping things in the trust, it actually avoids, any legal issues with creditors or predators, forever. Again, definitely if they're managing and doing things essentially that they need to be doing, just like an S corp, just like an LLC, just like any entity, they have to maintain it the right way. But if they do that, that's where you get the long-term asset protection and tax benefits. That's what makes these things attractive to high net worth families and individuals.
And the trust can buy and sell properties. So, and anything that the trust purchases, like anything for those properties, you can pay for with the money in the corpus of the trust on a pre-tax basis. Most people are, earning their money, they're paying tax on it, and then they're paying for things like the utilities, the gas, the lawn guy, like whatever, the pool guy, on a post-tax basis. They're earning their money, they're paying tax on it, and then they're going and paying those bills. So it's just a much more efficient way when you're utilizing a trust. And this is what like the top 1% of the 1% do in this country, and the wealth builders in this country. They pay for things on a pre-tax basis legally,
Yeah.
So
Can we include properties with mortgages in the trust? Yes. So good question. We get this question quite a bit. So when you're transferring in, let me just draw this out. Let me go back on my whiteboard. So I can draw this out, and hopefully it'll make more sense. So when you're transferring properties to a dynasty trust, you're doing it, let me just clear this off. You're doing it through sale. Typically, when you do things with a trust, when you're transferring assets or conveying property from, we're just going to put PE here. This is your personal estate. And then we're going to put blue here, your trust estate. Typically, how people do that is they do what's called a grant or a gift, right? You're gifting properties or granting. That's why they call traditional, garden variety trust, living revocable trust. They're also called grantor trusts. So you're granting assets over into the trust. So that's typically how you're going to convey property over to a trust. 99% of the time, if you're using a standard revocable trust, things like that. with irrevocable trust, specifically with dynasty trust, because you can grant things into irrevocable trust as well. Obviously, there's some gift tax implications and things of that nature, but with the dynasty trust, we're doing it. We're basically essentially creating a financial transaction. So again, personal estate, trust estate, but instead of granting the property over, we're going to sell the property. We're going to sell it. No different than you would sell it to a new buyer of your property. So there's going to be, notarized bill of sale, purchase and sale agreement, deed, warranty deed, quitclaim deed, all whatever it is. Most of the time, it's going to be a quitclaim deed, since you're the trustee of that trust. But you're going to sell it at cost. So even if the property in that situation, instead of them selling that property for $1.8 million and getting hit with that huge capital gain, they would have sold that property to the trust, right, at cost. So they could have sold it at $300,000, let's say, for example, $300,000. Now the property's in the trust, and then the trust can then sell that property for $1.8 million. Okay. But when we sell that property over to the trust, we're selling not only the property itself, but any type of note arrangements as well, including the mortgage. So when we sell the property to the trust, we're also what's called assigning the note. We're going to assign the note to the trust. Okay. And so now we can use the money inside this trust to pay for the mortgage and all that stuff. Essentially, the bank there's not going to be a big transition from a property standpoint, from a property record standpoint, I should say, because a lot of people will say, oh, well, what if they do what's the word I'm looking for? Due on sale. The bank triggers the due on sale. Hey, you sold that property, you got to pay the mortgage. Not necessarily so, because of how trusts are structured and because of certain laws, specifically the Garner-St. Germain Act, prohibits banks from calling loans on certain types of trusts, depending on how you transfer and convey the property over, who the trustee is, all that stuff. But essentially what we're going to do is we're just going to assign the note there. Okay. So that's pretty much all that's happening. You sold the property over. Now it's legally owned by the trust. It's not owned by you anymore. Why? Because we did it through contract. You get a notarized bill of sale, purchase and sale agreement, deed. Now the property is owned by the trust. The trust owes you money. So once you sell the property over to the trust, there has to be some consideration, right? There's a financial transaction happening essentially. So what happens in this case is we basically assign a note payable in the trust, because these trusts can carry debt. A lot of trusts cannot carry debt, but this trust can. So essentially, there's going to be a debt note in this trust for that amount, for that $300,000. Just call this an IOU. We call it a demand note. It's still the same thing. It's a note payable. So the trust owes you money at some time in the future. How that's constructed, because we're doing it through a private arrangement, there's a lot of flexibility with that. So it's not like a standard installment payment where we have to take payments over 10 years and all that stuff, phantom income. None of that stuff is the case. So we can basically, once there's money in the trust, we can essentially take from that note on demand. So let's say we needed $10,000 or $50,000 from the trust. Hey, the trust owes you $300,000, right? Because you sold the property over to them for $300,000. So once the trust has money in it, then you can borrow against that demand note and use that for whatever you want. But again, a majority of the things that you can do as an individual, you can do within the trust. Again, education, investments, things like that. As long as it's structured and put together right, you can use the money inside the trust to pay for that. So there really is very little need to take distributions, taxable distributions from the trust, because that's the downside of trust, is that when you take distributions from trust, they are taxable. And no one likes to pay taxes. that they don't need to. So, but
But
good question. Hopefully that answers your question.
so yes, the long and short of it, yes, the properties with mortgage, it can be in the trust. And you can also pay yourself a salary for managing the trust too. So if you need some income for your fun, food, and fashion, just never pay $1 more of tax than you need to live on. Okay, that's the rule of thumb. Never pay $1 more in tax than you need to live on.
Any other questions? Thanks for the thumbs up, Akbar. Let me check on live stream because I got some live stream questions. Okay, here. Okay, Michael says, how does the trust work? So you're telling me I can use money in the trust to pay for a vehicle? Yes, that is correct. You can use the money because it's trust money now, right? All the money's in the corpus of the trust. You can use the dollars as a trustee. You can make an executive decision because the trustee has the control, right? So you as a trustee can make the executive decision to go purchase a vehicle, and you can utilize the vehicle. The only thing is, if you're going to use it for personal use, you have to, basically lease it to the trust. You'd have to pay a lease fee. We call it personal use lease or caretaker lease. So you can, because remember, the money in the trust is for the benefit of the beneficiaries. Right. So if there's the beneficiary's car, that's one thing. But if you, as a trustee, are using the car, you would have to pay a lease to the trust every month for doing that. And that could be nominal, 200, $300 a month, depending on the value of a car. You go buy a Lamborghini, you got to justify that. So there's limits. But yeah, we do this all the time. Matter of fact, that's what we do ourselves as trustees. We, our both of our cars are owned by the trust, and we use the vehicles to obviously take our kids around and do this and do that and everything. But we pay a lease to the trust every month for the use of that vehicle. But again, the trust is paying for, the car note, the insurance, the maintenance, needs new tires, all of that stuff. It's
The
trust
gas,
expense,
pay
the
for our gas
gas.
on a pre-tax
Yeah, yeah.
basis. Mhm.
All that stuff is paid for with money inside the trust that, again, is not getting taxed. So it's just a much more efficient way to do things. But good question. So that's it. I think that's it for anyone else. Have any other questions? Is the only other question that we had on live stream.
Stefan, this is Akbar again.
Yeah.
Just a quick question about um, you're making, for example, you're making certain income on an LLC or a corporate S corp. Um, when if that money is parked in that entity, is it still taxable?
If you mean in the trust, you mean, or in your
No, not in the trust. Sorry, this is
okay.
not. This is related to the
That's,
LLC or an entity.
yeah. I mean, if any income that you have inside of that, and this is the thing with S corps and LLCs and stuff, is that income has to get distributed right at the end of the year. You can't just retain it in there like a C corp or C corporation. You can actually retain earnings. There's some limits and tax implications when it comes to that, but that income essentially has to get distributed out at the end of the year. So what we're saying is, if you're going to do like the spousal partnership strategy, for example, is hey, have it, set up your LLC, but have it taxed as a partnership, and then have your spouse take all, a huge chunk of that dividend that you were going to pay yourself. It's essentially the same thing as taking a dividend from the S corp, but there's no restrictions as far as reasonable compensation. That's the biggest thing. Again, if you watch the part 1 training with S corporations on our YouTube channel, it goes over that in detail. But S corps are becoming much more heavily audited because people aren't paying themselves the reasonable salary. And the IRS is kind of caught up on that because you can make $1 million and say, hey, I'm going to pay myself, $5,000 salary, depending on what you're doing, your business, your experience, your job duties, you got to be able to justify that. But then there's people on the opposite spectrum that pay themselves, seven, 800, $900,000, and it's not necessary. So there is a reasonable compensation that you can pay yourself that meets the IRS muster, as long as you put the documentation together for it. But the partnership avoids all of that because you don't have that requirement. So it gives you a lot more control to figure out how much income I can have going through my partner, through your spouse, reduce that self-employment tax. You also get that 20% tax deduction, the qualified business income deduction. I forgot to mention that. But it's all pass through income.
How does that work in a scenario where you have a S corp owning an LLC, or there are multiple child entities under an S corp? You can still distribute among all those as well.
Yeah, well, that's where we get into planning, and a lot of times people will do the different waterfall methods or stacking methods where you have this LLC and this S corp in Nevada and Wyoming and all these different things. A lot of times that's really not necessary. It really depends on your how you're operating your business. Do you have other similar businesses, stuff like that? You have more than one business, so a lot of that stuff at the end of the day, it's probably not even necessary. But if you're gonna operate an S corp, the goal is to not leave as much income in the S corp at the end of the year, and so the Dynasty Trust allows you to do that, to redirect income through that. But again, the big thing is you have to pay yourself a reasonable compensation. There's issues with step up in basis, capital gains, especially if you own real estate. It's really not a good thing inside the S corp.
Thank you, sir. That's all for me.
Okay. All right. So if that's pretty much it, then I hope you guys enjoyed this session. Again, if you didn't watch the part 1 of the session, make sure you go ahead and do that. Go to our YouTube channel and watch that. What I'm also going to do is type in the chat, because a lot of you guys may want to have strategy sessions with me. So I'm going to put in my cell number here. I'm actually leaving out of town this week. We're going on a little vacation. But I'm going to put my cell number in here. And I'm also going to drop in 2 words. And those words are talk and TALK, and then eval. So if you want to just have a one-on-one session with me to kind of talk about your situation more in detail, answer some questions, we can, go over things more specifically versus, airing out a lot of your dirty laundry on a Zoom call, then send the word talk, TALK, to the number that you see, the 919-420-3798, the number in the chat. And then you'll get my link to schedule a one-on-one session with me. It's an hour-long session. We can kind of go over your stuff a little bit more in detail on that. If you want to schedule a tax and estate evaluation where you're sending us documentation, we could look at your most recent tax return. You can redact any personal information. We don't need to see social security numbers or names, addresses. We just need to see the numbers. We can take all of that information, put it together, and put an actual plan and show you, hey, this is how things need to be mapped out. These are how your entities are structured. You may want to look at restructuring this here and there. We can kind of draw it more down in detail exactly what strategies and structures you need to implement and how to do that. So if you want to do that, then you will just text the word eval, EVAL, to that number that you see on the screen there, and you'll get the link to schedule tax and estate evaluation. So that's pretty much it.
The Tax and Estate Academy, if you're looking for the YouTube channel, it's an ampersand for the and. Just so if you're on YouTube and you're searching it, it's tax, use the ampersand for the and.
Yeah.
Estate Academy.
Yeah, and but if you're doing a search on YouTube, it might just come up if you type in the Tax and Estate Academy, You'll see my ugly mug on there and all our videos. But anyways, but yeah, definitely go ahead and watch that. That'll help some more. And then next week we'll be drilling into some other things when it comes to S corps, and then hopefully that'll be it. If we need a part 4, then we'll do that. But hopefully this was informative, especially for those of you guys that have real estate and you're considering putting properties in S corporations. Hopefully you see that it's not such a good thing in most cases. So that's pretty much it. Thank you guys for coming on the call, and have a good week, and we'll talk soon.
Bye. We'll see you next
Thank
Tuesday.
you. Bye-bye.
Bye.